Quant Insight are very excited to introduce Oksana Grinchak, who is joining us today for a very special interview where we step outside our normal comfort zone of looking at global equity, bond, currency markets and instead focus on crypto. We want to take a look at the basics of crypto, which Oksana will talk us through, but also we want to focus increasingly on how traditional fund managers need to start thinking about how the likes of Bitcoin will sit alongside their traditional asset allocation mix. So Oksana, as an OG of high finance, on the buy side, the sell side, traditional metrics and crypto, would you mind just giving everyone a little introduction of yourself?
OG of traditional finance, not so much of crypto, except for my initials.
Now, I'm going to betray my ignorance, and I think this is a question that few people would admit because it's a little bit, it betrays your lack of knowledge. But can we address the elephant in the room? Is crypto safe? Could you answer, if you are a retail investor who wants to get involved in the space for the first time, but you're worried, can you allay their fears?
I would say it is possible to buy, hold, trade, and even participate in the ecosystem in a safe way, especially these days after, the events we went through in the last 2 years. It is also possible, it's still possible to get scammed. So I think the important thing for a retail investor is to decide what the objective is. For example, if all you want is to buy crypto, hold it, forget about it, wake up 10 years from now when the price is $1 million per coin, that is one strategy. And if you want to buy crypto and tactically trade around it is another. So for instance, in the former case, the easiest thing would be to pick a safe exchange. And now we have regulated exchanges. One of the biggest ones is Coinbase, SEC regulated. They will ask for all your identification information, for your residency, for your tax residency. In fact, if an exchange doesn't ask you this information, be careful about it. You will get a wallet on the exchange. You can purchase Bitcoin as an example. And at the same time, there are what we call cold storage solution. You can think of it as a USB, that it's a hardware that you can purchase separately and then transfer your holdings into effectively USB and leave it there, except of course you have to be very careful about your call it password.
Yes, I've heard some horror stories on that front.
Yes.
So that's for a hold on for dear life type approach, or buy and hold in my language. What about if you're a more active day trader type, high frequency person?
It's important to pick an exchange that you're comfortable with, an exchange that you can try, give it a few months of working with an exchange, contacting the customer service, for example. And I have to say that even the most reputable exchanges, sometimes it takes, you get to speak to customer service straight away, but issues may not get addressed for a few months, and it's still a process. You have to try and see, but there are definitely trusted names, regulated, and perhaps even not regulated, but you can do research and find one that you're comfortable with. There are red flags, of course. I would say if at the moment the examples of scams that I have come across at some point, you open an account, you see terms and conditions on the website of some platform. The terms and conditions mention an account opening agreement. And then when you do open an account, you provide an email and choose a password. And then there is no document. There is no account. So account opening agreement. It's important that whatever you do, there has to be some legal agreement between you and the platform. Another example would be if a platform asks you, this is something I did come across in the last few months, which shocked me, a platform that only takes crypto from you, for example, stable coins, which we can get into later, and allows you to trade Apple and Google and Tesla stocks and so forth. That is a huge red flag.
Okay.
In fact, this is what we call tokenization, and that there are thousands of lawyers working on trying to make it possible. So if there is a broker and the platform says, give me your tether and go off and trade Apple stock, that's a
sign.
Red flag.
Given your experience from the traditional finance side and now the crypto side, is it any more dangerous to an average retail investor investing in this space versus buying stocks and shares?
It is. I would say it is still, because buying stocks and shares, you usually go through a regulated broker, and unless it's the newly issued spot ETF or some vehicle
which we will
like
no doubt talk about later.
We'll cover. I think one aspect of crypto which is perhaps underappreciated is once you click send, once you have a wallet and you have assets in your wallet, once you click send, it's gone.
Yeah, it's irrevocable.
Yes, and I think it's still a little bit underappreciated because if you have a faulty transaction, an error or fraudulent, you call your bank and you still have hope that they reverse it, right? And that's having a bank in the middle actually scares a lot of people, and that is a premise behind crypto to a huge extent. But also do not forget, once you click send, it is gone. It's not your property anymore.
In a way, it's a very black and white issue, I guess, because for some people that whole decentralization is a massive appeal. For someone like me, it scares the bejesus out of me because of that lack of recourse. But I guess that's a leap of faith, and once you get comfortable of all things in life, you just...
So as we started, there is a cold wallet, which is, you can think of it as a USB. You can buy and hold and not touch it for a long time, perhaps even when you go on a website and everything is listed in Bitcoin, prices are listed in Bitcoin. You can have an exchange wallet, which does not belong to you. The assets belong to an exchange, but if you've done your research, it's a hopefully reputable, safe place, and you can trade in and out, and at some point you can take your assets out into the cold wallet. And then there is a crypto ecosystem was what they call DeFi, decentralized finance, which is heavily skewed towards borrowing and lending platforms, although some other projects as well, where you need a very active access to these platforms, and what you use is effectively a browser extension, or we call it a hot wallet, and those are the most tricky, the most dangerous, and there are a lot of examples. So one of the oldest one is MetaMask. Coinbase, the regulated exchange, has recently launched their layer 2 base layer, which has hot wallet as well. We're getting better and better options in that space. So as I said in the beginning, it's important what the objective is and what you're going to do with your
So I would summarize that. Tell me if I've got this wrong. Firstly, you need to understand your own risk tolerance. Are you buy and hold long term, or are you going to be more frequently in and out? Secondly, you need to do your own research about the validity of the counterparty you're going to. And then third, you just have to also be diligent with regards to reading terms and conditions and looking out for some of those red flags you mentioned. And if you do those, hopefully it's kind of on a par with traditional investment vehicles.
But again, it does happen. You go on a website, they give you a page with the names and photos of the founders, and the founders, you go on LinkedIn and those people have no reference to the name of that platform. They're not the founders, or, that they're deep fakes. It is still happening.
A bit
it's
Wild
possible, but it's just very, very important to be very responsible.
Do your own research. Cannot be overemphasized. Got it.
Absolutely.
What is Bitcoin? What's your view on it? The context, the history? And I know you've brought a couple of charts along to give us a sense of the history of how Bitcoin has evolved. But if you could give us the kind of 101 overview, that would be great.
Let's explain Bitcoin as simple as we can. Bitcoin is a piece of computer code, C++ computer code, actually. And what it does is it gives the rules of how to keep a ledger, a database. You can think of Bitcoin software as a way to manage an Excel spreadsheet. And the code has been simplified to manage a spreadsheet of transactions only. I mean, now we're actually doing much fancier things with that code, but apparently wasn't intentional.
The basic view is fine as far as I'm concerned.
So imagine if we take a piece of paper and scribble on it, Oksana owes Hugh $100. And we take that piece of paper and walk around the world and convince everybody that this is true, one way or another, but me saying, I agree, you saying you agree, and then everybody. It becomes money because everybody in the world includes, Waitrose around the corner or Selfridges. So you can take that piece of paper and actually go spend it because they have accepted the fact that now you have $100 and I don't. This is the idea behind, this is how it becomes money, right? Yeah. So I would split it into steps. One is first how to facilitate this transaction between two people, how we can moving $100 digitally in a way that I don't have it anymore is the first step where cryptography comes in. So I'm not going to get into too much details. It's more complicated than sending a password protected PDF file, but it's done in a way as if you dropped a letter in a post box through a small opening, right? I don't have it anymore once I dropped it, and only the person with the key can open it. So there's this security of transaction between two parties, and the second step is how to add this transaction to the ledger, to our database, where everybody agrees that this is true, just like as we walked around the world.
The authentication side of things.
Yes, and who keeps track of that ledger, right? So they say you go back 5,000 years to ancient Egypt and you find incisions on a stone saying Abdullah owes Fatima bushels of wheat or something. This is the same idea, but instead of set in stone, we have an Excel spreadsheet, and who keeps track of it, right? So, and this is where the genius of Bitcoin actually comes in, I think. So if our network, everybody who downloaded the software, if we want to maintain this ledger, where do we keep it? Google Drive? Well, Google owns it. Some website, the website owns it. Internet is not a very democratic place. And the solution was that every person with that computer software, call it a node, keeps it. Everybody keeps a copy. Of course, then the question is, you can go into your ledger and add a few zeros to your account. How do you actually agree on the same version? And that's the second place where cryptography comes in. And this is kind of where cryptography meets game theory. And the idea is that if you start with a ledger that everybody agrees on, new transactions are thrown into a hat, and the nodes pick transactions out of that had mempool and do the work of making sure everything is correct, meaning you're not trying to spend the money that you don't have. The private key and public key match. And have we actually, the two parties agree and everything is fine. And once you've done the work of verifying every transaction, and they're grouped into blocks, so we don't have to approve each transaction at a time. Once the block is built, we add another amount of kind of useless work on top of it. So the solution here is that every node keeps the ledger. In that way, it's decentralized. And the trick is, how can each node agree on the identical ledger? And this is the consensus mechanism. That is the kind of the genius of Bitcoin. And the way it's done is, suppose you start with a ledger that everybody agrees on, with an Excel spreadsheet. So it has to be
unanimous. There's no
Excel spreadsheet that everybody agrees on. And then there is a whole pool of new transactions. And node operators pick transactions that have been broadcast, and their job is to go through them and make sure that they're correct, that the parties transacting have signed off using their keys, that they're not spending money that they don't have, and so forth. There's a lot of work that goes into it. Having done that, so they package transactions into one block. So Bitcoin is designed so each block is approved on average around every 10 minutes, and it has a fixed size. The way we're going to ensure that this block is added to the ledger is to condense this information into one string of a fixed length that looks like a random number, but it's anything but, because if you change anything in the underlying data, even the order or comma or anything like that, it will change the string in a way that cannot be predicted. And on top of that, we're going to force each node to do an extra amount of pretty much wasted work by picking a random number that ensures that the resulting string, so-called hash, fits a certain criteria. And this is similar to opening a safe, cracking a safe,
Okay.
looking for some combination that fits. So the way a block looks, top line is the previous hash of the previous blocks to create continuity, and then you get the data that goes, the transactional data or any data that goes into the block, and then there is the random number that is very difficult to find, so that resulting hash ticks the box. In fact, the criteria is a certain number of zeros in front of this hash. And once you've done that, everybody else can verify very easily. So finding that number is difficult. Verifying is very easy. And once you've done that, every other node can check your work and add it to their ledger, to their Excel. So why would they choose to pick the guy who solved the problem first? And this is where the proof of work kind of genius comes in. Imagine you're trying to do something dodgy, to squeeze a transaction that is not valid, and you happen to be the first computer, the fastest computer who managed to do that, and everybody took your block and added to their ledger. Now we have a commonly accepted ledger with a fraudulent transaction. Well, when the next block arrives, you again have to be the fastest guy who's done that, so you manage to squeeze the same fraudulent transaction that was not in the hat. And the next block arrives, you have to be the fastest guy again and again and again. So the amount of computing power that is required to put through some dodgy transaction is unbelievable, is inefficient. So I want to stress that every node, every computer who's working on this, nobody forces anybody in the blockchain to do anything. They don't have to accept your block. However, it's a stable equilibrium for participating nodes to pick the one that the most work gone into. It's in their interest.
So it's self-reinforcing credibility in a way.
Self-reinforcing equilibrium, and this is where kind of cryptography and economics of cryptography.
Yeah.
And now, there's one thing I haven't mentioned. What also happens in the block, you would ask, why would any computer spend all this effort?
Yeah.
And yes, after the top hash line, which duplicates the previous block, only to make sure that you've got the ledger. The second line actually reads that the miner who created this block gets X Bitcoins.
Okay.
And this is how the kind of this ledger money is created. This is the economics of the blockchain. So by being the fastest guy who spent the most work producing a block, you actually get a compensation in the units, in the currency of this network. In fact, the very, very first block that was ever created, but by Satoshi Nakamoto, which we don't know who that is, there are no transactions in there. You only entry in that block is the new 50 Bitcoins that were created in this way. So, and that's actually another thing, that everything that happens in a blockchain, or at least on Bitcoin blockchain, is transparent. You can go to Blockchain Explorer, you can look at every block ever minted. The number of zeros required for the first block was, I think, 8. But you can go and check that out for yourself.
So if I could just interrupt quickly, Oksana, apart from obviously the hype around the ETFs of late, the other thing we keep hearing about obviously is the halving, which is due imminently. It is an April event. To a newbie, can you explain the concept of halving and how it works?
So when we were discussing how a new block is added to the blockchain, the structure of the block is such that the miner gets paid newly created coins as a reward for doing the work to building the block. So, and the number of coins, the so-called block reward, is fixed, and it started with 50 Bitcoins, and it's slashed in half every 210,000 blocks, which give or take is about 4 years. Okay. So every 4 years, the miner who won the lottery of being the one whose block gets approved, their reward is
It's cut in
halved,
half.
which basically mathematically means at some point that block reward will diminish so much that
To zero.
almost to zero, which is actually an interesting area to focus on, and there's a lot of discussions about it, that why would a miner continue to do the work?
What's the incentive?
Yes. So the miner gets paid from the newly minted coins as well as transaction fees. So if you and I have a transaction that we want to have included in a block, we can incentivize the miner with higher transaction fees to include us in this block, not in the next one. And at some point, the proportion, the share of transaction fees versus block reward will be basically the majority,
that becomes the lion's share.
Yes, there's a lot of discussions around it because it could potentially, and again, this is no secret, there are Princeton papers and academic papers written about it, that when majority of the reward comes from the transaction fees, would that introduce an sort of unstable equilibrium when a miner could be manipulated by the incentives alone.
Yes.
And that's an interesting discussion. Again, as I mentioned earlier, Bitcoin was initially intended to be a transaction ledger only, very simple code, but it does allow for fancier things. And maybe you heard from us, especially from last year, they started the expression programmable Bitcoin. They started even building NFTs on Bitcoin. So the information that goes into a block could be more than just transaction, and that requires higher transaction fees, and that will keep miners interested. And we'll see how it will develop. But the very clear 4-year cycle has been very important for the adoption, for the ecosystem.
Been a massive story in the beginning of 2024 because we've had the demand explosion from the ETF side and then the supply constriction from the halving.
Well, if we had this podcast 6 months ago, I would have said there's 3 stars that are getting aligned for Bitcoin. It's the upcoming halving. No secret about it. It's all scheduled. It's there. Supply will go down, but potentially higher demand on the back of spot ETF. And the development in the clearing space, as I mentioned, that could also be a new kind of door opener for a universe of investors that have not touched Bitcoin yet. So if you align these kind of 2 factors on the demand side with reduced supply, that creates a very solid background.
Only one way price is going.
Yes. We had the last bull market, you can say, was between 2019 and end of 2021. Simply Bitcoin itself, I'd say the performance over those not quite 3 years was maybe 15x. 15x. And if you were actively involved in crypto space, meaning also investing in other assets, Ethereum and everything else, I was not at the time, but from my experience and people in the space, you could have probably had 100x performance. 150x performance. It was definitely the bull run in crypto can be quite lucrative.
So, Oksana, we did actually poll some of our clients out there and get a smattering of questions for you in anticipation of this interview. And one very basic question is, what's it worth? And what's the potential upside that an investor can get by playing in this space?
I think that's a great question, especially that people are hearing on media and social media. Bitcoin is hot. I go to see my osteopath and she tells me Bitcoin is through the roof. So it's probably worth to look at a few charts to put kind of Bitcoin performance in context and where we stand. So for example, if we start with a very simple chart of plotting Bitcoin price, but on a log scale, when something moves very, very quickly and aggressively, it's better to look at percentage changes. That's all it does. I started from 2015, I believe. This is kind of about the time Ethereum came into place. So before that, it was just a very obscure asset. And as you can see, it's got a very nice pattern to it. And we call it kind of the adoption pattern. In fact, if you plot gold on a log scale, you might sort of see that diminishing return. And what's also interesting about, it's a very simple chart, but what's also interesting is that it follows a very clearly defined channel.
Yes.
Despite the rally that we've seen, we're barely above the middle of that channel. So if you were simply working off that chart, it would tell you that within the next 12 months or so, you would still expect the Bitcoin price to reach somewhere 120,000. So there is something like
loads more
2x.
upside yet.
No. No, it doesn't say that. I mean, it may still go to 1 million, but sort of 50,000, 50,000 is sort of the middle of the channel at the moment. Kind of gives you some idea where we stand, despite reaching all-time highs again and all that. You purely from this adoption cycle, you can still argue that there is some upside.
So that leads us to another question, which would be, how do you value Bitcoin? So we're coming up with an idea that 50,000 is middle of the channel at the moment, and 120,000 is plausible, 1 million is plausible, especially now as we talk about to our institutional portfolio managers who might start thinking about investing in this space. Other tools, what other analytics do you employ?
Again, there is a number of analysis tools that are specific to Bitcoin and also specific to crypto. And one feature that we already discussed, that this technology is very transparent. Transactions, wallets, movement of assets across wallets, it can all be easily monitored, well, at least for the spot space. And there is a whole industry of how people approach and analyze. But as an example, I just brought a couple of charts for us to look at. And one measure, for example, is each wallet and effectively each coin created can be tracked, and we can actually monitor the age of the coin. When was the time it last moved? When was this coin purchased? Whether they changed hands or not.
So are you describing kind of entry level effectively there?
You can monitor the movement of coins and at what price that took place.
Okay.
So if you do that, it's actually not a very complicated process to estimate the entry level, at what price a certain wallet, certain coin was purchased, and how long it stays in that wallet, and when there is a movement. So this is being
great
done
transparency.
Yes, I wish we had that.
In our world.
In our world, yes. And then the second, I guess, value proposition could be AI doesn't just need data; it needs quality data. So there is a feedback loop that, to filter out quality data, you would probably impose some economics on it, and this is where crypto could help. Although at the moment, most projects in AI meets crypto or Web3 are actually around physical semiconductors and the whole deep-in decentralized physical infrastructure. So that's what actually taking off, because this is where a lot of demand is.
Hugely diverse area, and there's lots to talk about, and we've just kind of skimmed the surface, but we will do this again. Thank you very much for your time.
Fantastic. Thank you so much for having an opportunity.